Hello and welcome to the Friday Market Update. Well, let's start with what everyone cares about most, mortgage rates. Actually, that's what I care about. But anyways, according to Mortgage News Daily, 30-year conventional rates are sitting just above that 6% range for a prime conventional borrower. And overall, we've seen a pretty stable week. I love stable weeks. FHA and VA rates are still in the mid fives, looking really good for first-time home buyers for sure, and the veterans alike. What I love is that we've seen mortgage rates now below 6.5% since September of last year. And that word right there, stability, is really the story, because when markets are jumping around, buyers just kind of freeze up. But when they're steady, buyers start to move. And Wall Street, let's talk a little bit about Wall Street versus the Fed. Here's something that's really interesting happening behind the scenes right now. The Fed is still talking about inflation, and they're still reacting to the data like the December PCE, personal consumption expenditure, which is the Fed's favorite measure of inflation. But here's the problem. That data is almost 2 months old because the government shut down back last year, and they're way behind. So it's reporting for the month of December. That's old news. The market we're in today is very different from what we saw back in December. And Wall Street, they know it. They know what's going on. They have their pulse on the marketplace. So what we're seeing right now is Wall Street starting to kind of shrug off some of this older data while the Fed is still trying to catch up. So we truly have a data problem. And this ties into a bigger issue: confidence in the government data. We've now seen some pretty significant revisions to jobs reports, especially when you compare the BLS, Bureau of Labor Statistics data, that is the headline number that comes out on the jobs report, versus the QCEW. I know all these acronyms, Quarterly Census of Employment and Wages Data. So what they do is they take the BLS numbers initially, they report them to Wall Street, the media, and then all of a sudden they kind of firm them up with the QCEW. And in some cases, those revisions have been hundreds of thousands of jobs off. That makes a big difference when it comes to what the Wall Street is trading off of. And honestly, it has not helped the buyer at all. So that's not a rounding error. That is a major, major miss. So what's happening? Because of the government shutdown we had last fall, Wall Street started to rely more on some of the private data, the real-time indicators such as ADP and the CPI. Those are the reports that they are now starting to look at, as well as other non-public information that comes out that they can really get a gauge for what's going on in the economy and jobs. And they're doing their own research instead of just taking government reports at face value. And honestly, the recent government shutdown may have been a blessing in disguise, because it did force the market to look at other sources of data and not rely exclusively on the Fed data. But the reality is the Fed does still matter. It does. And now, with all that said, we can't ignore the Fed. They control monetary policy, and they can control the direction of the Fed funds rate, where the direction of the interest rates are going, and ultimately they still influence where interest rates end up. So there's a lot of attention right now on Kevin Warsh, who's in line as the potential future Fed chair to replace Jerome Powell. And that could happen here in May. There's hope that we may start to see some more modern, real-time ways of measuring the economy from the government, instead of just relying on the reports that get heavily revised month after month. It's unbelievable, the BLS job revisions. So in my opinion, the bad data kept interest rates higher for longer, preventing many home buyers from being able to buy a home. It's truly, truly unfortunate, and has been extremely frustrating to me, needless to say, because the reality is the market moves fast and policy needs to keep up, and it hasn't kept up. So what this means for mortgage rates, so where does that leave us today? Honestly, the market has been pretty calm. I'm very happy where the interest rates are, and they've been pretty steady, Eddie, and that's a good thing, because stability builds confidence in the consumer. And right now, I believe rates are likely to stay in this general range. And if they do, that sets the stage for a much healthier housing market this year. I still believe we will drop on the conventional mortgage interest rate down to around 5.7, 5.75. And that will be a very good rate. I think we'll see some psychology buying where the buyers will get off their seats and actually jump into the market. But the real story is also the demand. So let's talk about demand, because this is where things get interesting. And Lawrence Yun, the chief economist for the National Association of Realtors, said that the 1% drop that we've seen in mortgage rates from the beginning of last year to this year, where they've dropped from essentially 7% to 6%, can bring in as many as 5.5 million potential home buyers just from an affordability standpoint. Now, granted, we know that all of those buyers will not jump in all at once. They won't. We only had 4 million, a little over 4 million sales last year. But even if 10% of them do, which he's predicting, that means an increase in demand. That's about 550,000 additional home buyers that can actually go buy a home. And that's exactly what we're starting to see right now. Some buyer activity, pre-approvals, loan applications. So let's break it down into real numbers that the buyers can understand, because this is what matters to the buyers. If you look at a $500,000 mortgage at 7% last year, the principal and interest payment was $3,326 at 7%, okay? But today at 6%, that payment would drop to $2,998. That's roughly a $330 a month savings in the mortgage payment. That's a lot of money. But over time, that adds up for sure. But here's the bigger point. If a buyer could afford that payment at the beginning of last year, but didn't buy because they thought the interest rate were too high, that same payment today gives them about $54,000 more in buying power. So instead of buying maybe a $500,000 house, they could buy a $550,000 house. And property values did go up last year, but not at that same pace. That would be like a 10% increase. Well, that mortgage payment is allowing them to buy a little bit more this year. So a buyer can definitely benefit in this market and should seriously consider buying right now while the getting's good. And the getting is good because the sellers are still providing seller incentives so they can get some seller concessions at the same time. So that's a big difference in the type of home they can buy. So here's the big picture. When you step back and you look at everything, rates are more stable. Mortgage payments are more affordable than they were last year. Demand is starting to come back into the marketplace, and the market is gaining confidence. It's getting confidence that we have some stability. And this is a kind of environment where buyers start to move again. So the biggest risk right now isn't mortgage rates going up or down. It's waiting too long while the market stabilizes and more buyers decide to step back in. So this is one of those moments where being proactive matters. Be the buffalo. My friend Sharon says, use that analogy. Be the buffalo, charge into the storm before all the herd comes into the play. So whether you're a buyer trying to understand your options or an agent helping your clients navigate this market, let's put a game plan together for your buyers so they can get in now, because the opportunities are there right now for those who are ready to move. Hope you have a great weekend. We'll see you next week. Talk soon. Gaylord out.